Yes. Hi, students. Can you hear me? Hi, students. Can you hear me? Hi, students. Can you hear me? Okay. Sorry for delay in a class. Basically, there is some technical issue due to which I am facing the problem, but hopefully now the problem has been resolved. So now, without wasting the further time, let's start the work. So now you are looking at again a past paper. It is from December 2024. And first of all, as you people know that we are having the question number one, question number three, and question number four. So this is the question three. This is the question number three of that attempt. So first of all, look at the background. C company, computer hardware. It also buys and sells software licenses, and it has financial year ended 31st December 2007. The following exhibits available on left side of the screen provide information relevant to the question. The first exhibit would be relating to the bundle of goods, providing information regarding the sale of the bundle of goods. It seems that it will be from IFRS 15 revenue, then discontinued operations, outline the sale of software license, and propose presentation in the financial statement. Then land, outline the purchase of the land originally intended for use as an employee car park. and option to purchase a building. Describe the purchase of an option. So these are the four exhibits. Now, look at the requirements. First of all, the first exhibit at the requirement 1, the requirement A is relating to exhibit number 1. Exhibit number 1. So using exhibit 1 and in accordance with IFRS 15 revenue from contract with customer, discuss how C company should allocate the transaction price to the hardware package sold to heat company and show all calculation. That is the first requirement. So let's focus on this requirement first of all. So this is the exhibit number 1. C company entered in a contract with the customer H company to sell a hardware package comprising of a computer, a monitor, and a printer of $2,000. C company will supply each of 3 products at a different point in time according to the need of the customer. C company regularly sells the computer separately for 1720. However, the monitor and the printer are new models and are not yet sold separately. C company knows that competitor companies sell a similar specification of the printer for $180, which C company feel reflect entity cost and margins, and the cost of produce the monitor is $150. And C company achieved the gross profit margin of 25% on selling price of its product. So first of all, dear student, this case study is relating to IFRS 15, revenue from contract with customer. Now, the C company has an arrangement with a customer heat company, and in that arrangement, the C company is having 3 distinct performance obligations. One performance obligation is to deliver a computer. Number 2, a monitor. And number 3, is the printer. And the C company has agreed to provide all these 3 things, computer, monitor, and printer, at a transaction price of $2,000 at the transaction price of $2,000. The C company agreed to provide all these three items for $2,000. It is the transaction price. Now, dear student, the challenge is that this transaction price of $2,000 need to be allocated among computer, monitor, and printer. If you remember in step 4 in IFRS 15, we need to allocate the transaction price among the different performance obligations. And in IFRS 15, we have a guidance that the transaction price should be allocated with the proportion of stand-alone selling price. It should be allocated with the proportion of stand-alone selling price. And in that case, the stand-alone price is the price which entity charge for a product if the product is sold separately. That price is known as stand-alone price. Now, the stand-alone price should be observable. It should be observable. And the problem is that the stand-alone price of the computer is observable. Only the computer stand-alone price is observable. The stand-alone price of the monitor and printer is not directly observable. So we have to estimate the stand-alone price of printer and monitor. And the problem and the method which we can use includes market assessment approach, cost plus approach, and residual approach. Now, if we talk about the printer stand-alone price has been estimated at $180, and it is a market assessment approach. So the computer stand-alone price was observable. Printer has been estimated using the market assessment approach. And to estimate the price of the monitor, we can use the cost plus approach. The cost to manufacture a monitor is $150 and margin is 25%. So if it is a margin, so you will take 150 divided by 75 into 25. You will arrive at the margin which company normally charge. And that is $50. So stand-alone price of the monitor. Later we have used the cost plus approach. Now, as we have now all the stand-alone prices, computer, monitor, and printer, 1720, 180, and 200. Now, on this proportion, we will allocate the transaction price of $2,000 in these three performance obligations. And the method to do it will be, first of all, do the total of standalone price. The total of the standalone price is 2100. So the computer price will be 2000 divided by 20, 100 into 1720. How we will distinct? It's a very good question. In this case study, the focus is only on the allocation of the transfer price, but how we will identify that how many distinct performance obligation we have. There is a rule in IFRS 15. And if there are two conditions, if two conditions are satisfied, then we have distinct separate performance obligation. Number one, the customer can benefit on its own or together with other resources readily available in the market. The thing which I am providing to my customer can benefit, can get a benefit from that thing on its own. He is not dependent on me. I am not the only sole provider. And number two, the entity has also promised to provide that good or services separately from the other. If these two conditions are satisfied, then we will treat the performance obligation as a distinct one, as a distinct performance obligation. Okay? Like if there is a condition that the monitor and the computer are integrated, they cannot be separated. The customer cannot buy it individually. If computer has to want to buy a computer, he has to buy a monitor. In that case, the computer and monitor would not be distinct performance obligation. Then they will be combined. Then they will be combined. Got it? Now, the total transaction price is 2000. Standalone total is 2100. So 1638 1638 will be the revenue which should be charged to computer, and for monitor 2000 divided by 2100 into 200. $190 should be charged to monitor, and the remaining should charge to printer, and that will be 172. So this is how we allocate the transaction price in these three distinct performance obligations. You got it? Any question? So from here the question is started, answer is started. In accordance with IFRS 15 revenue from contract with C company should allocate portion to the price at which an entity would sell the good or service on a separate basis at contract inception. IFRS 15 state that observable price of the good or services sold separately provide the best evidence of the standalone selling price. And if the standalone selling price is not readily available, the entity should estimate the standalone selling price of each element of the product using the information Okay, so they in a first paragraph they discuss it should be allocated on the basis of standalone and standalone price is readily available good, otherwise you have to estimate it. Now, as far as the standalone price is concerned, standalone price of the computer is available 1720, but individual selling price of the printer and the screen, the monitor are not available. Because of the standalone selling price for the printer and display screen are not directly observable, the company must estimate the standalone price. To estimate the stand-alone selling price, C company will use adjusted market assessment approach for printer and cost plus approach for the monitor. So to estimate the standalone selling price, the adjusted market assessment approach focus on amount which the entity believes the market to which it sells goods or services is willing to pay for the goods or services. In this case, the C can refer to a competitive price for a similar goods or service because the C company believes the company price reflects the entity own cost and margin. The standalone selling price of the printer will be 180, market assessment approach. And for screen approach, they will take the cost and add their margin. So for monitor, it is 200. And then we have the standalone prices. And then the transaction price will be allocated in a proportion of the standalone price. Got it? Any question? Now, after this exhibit, now we will move towards the second requirement of this question, that is using Exhibit 2, and in accordance with IFRS 5, non-current asset held for sale and discontinued operation, discuss whether the profit on a sale of a license should be presented arising from the discontinued operation in a profit and loss. So, whether the sale of license is a discontinued operation or not. Now, before I move towards the case study, remember the discontinued operation is the component of the entity which has been disposed of or held for sale, which present the major product line or is part of the single coordinated plan to dispose of a subsidiary, or it's a subsidiary acquired with the view of resale. That is the definition of a discontinued operation. Now we have to apply this concept on the given case study. That is the case study. This is the case study. Dear students, kindly read it. Okay, have you read it? So the summary is that the C company purchased and then they subsequently sold a license. The income is generated was small in context of the overall business. C company regularly buys license with a view to reselling them at any point in time. It owns several software licenses. The profit on sale of this license was presented as arising from the discontinued operation in a profit and loss for the year ended 31st December X7. This was because C company believed the license was a separate component of the entity. Separate component of the entity. Now, dear student, in order to be a discontinued operation, that component of the entity should be a major product line of the business or geographical area of the business, or it should be a subsidiary acquired with the view of resale. Now, the license is not a product line, it's not a geographical, major geographical business line. And in case of a subsidiary, it's not a subsidiary because in order to be a subsidiary, it should be a business. Business, if we talk about the definition of the business, business is a set of integrated activities which is managed in order to generate some return, and they have some sort of characteristic like there is input processes, subtractive processes, and there might be an output. That is the definition of the business. Now, the license is not a business, so it's not a subsidiary one. So we can't say that it's a subsidiary which we have acquired with the view of resale. Neither it's an major product line of the business or the major geographical area of the business. So I think to treat the sale of license and the gain on the sale of the license, I think in my opinion, it should not be presented as a discontinued operation. Yes, it can be a non-current asset held for sale, a non-current asset held for sale, that accounting might be applied, but it cannot be treated as a discontinued operation. Now, look at here. And this is the answer. So, a discontinued operation is a component of the entity which either has been disposed of or is classified as held for sale. And it represents a separate major line of business or geographical area of operation, or is a part of single coordinated plan to dispose of a separate major line of a business or the separate major geographical area, or it's a subsidiary acquired with a view of resale. This is the definition of the discontinued operation. Now, in accordance with IFRS 5, non-current asset held for sale and discontinued operation, the term component of an entity comprises operation and cash flow which can clearly distinguish from the rest of the entity. A component of an entity may be a reportable segment or operating segment, reporting unit, subsidiary, or any asset group. A component is usually identified at a level higher than a single cash generating unit. As such, license is unlikely to be the component of the entity. License is just a single asset. It's not it's not a reportable segment. It's not an operating segment. It can't be a company. It can't be a subsidiary. It can't be asset. So it's a single asset. So it is unlikely that it can be a component. So the assessment of the separate major line of a business is based upon size and relative importance of the business. The licensing revenue from the piece of software was relatively small in the context of overall business. However, numerical determination alone is not necessarily going to be determined whether the disclosure is recorded with the guidance in IFRS 5. The sale of a license was not due to coordinated strategic decision to end specific line of a business, but appear to be part of normal course of business, which include continuous change to the composition of license. Even though license has been purchased with the view of reselling, it does not constitute a subsidiary acquired exclusively with the view of resale. Therefore, license sold was not one of several individual sales. In conclusion, none of the criteria in IFRS 5 are fulfilled, and the classification of profit on a sale of license within discontinued operation was inappropriate. So, as we discussed, conclude that no, it should not be treated as a discontinued operation because it's not a component, it's asset, it's not a major product line, geographical area, it's not a strategic plan to exit from the complete product line or geographical area, or even it's not a subsidiary which has been acquired with the view of resale. So that's why it does not fulfill the definition of discontinued operation. Okay. Now we will move towards the next requirement of this uh, question. Question number 3. Two requirements we have completed. Now I will move towards the third requirement of the question, the third exhibit of the question. Just a minute. Okay. That is the same question, but I have opened this question on ACC practice platform. So now the third exhibit, first two exhibit we have discussed, bundle of goods, discontinued operation, and now we have a third exhibit, and the third requirement is using the exhibit 3, discuss how land and its fair value should be accounted for in the year ended 31st December 2007. Now here I think if we're talking about land, so maybe IAS 16 and might be IAS 40, property, plant and equipment or investment property. So discuss how the land and the fair value should be accounted for the year ended 31st December at 7. Now for that purpose, we have to read the exhibit. Okay, so let's read it. On 31st December X6, C company, on 31st December X6, a year ago, they have acquired a land for 10 million. And the intention was to turn it into an employee park. So the intention was to turn it into employee car park. And the land is recorded as a property, plant and equipment under IS 16. And it was the right treatment. If we have purchased a land with the intention to build a car parking for employees, then it's a owner occupied property. It's property, plant and equipment, and it should be accounted for under IS 16. Initially measured at cost, and subsequently you have an option to use the cost model or revaluation model. So till here, the things were right. It should be accounted for under IS 16, and it has been accounted for under IS 16 property, plant and equipment. But by 1st December X7, it's been almost 8 months, land had not been developed into a car park. Many employees had started working from home, meaning that car park was no longer required, and the C company decided that it would lease this land instead. The land will be leased. C company classified the land as investment property and measured it at original cost of 10 million. C company wished to use the fair value model in IS 40. However, as at 1st September X7, C company believed that it was impossible to measure the fair value of the land due to legal complications concerning the public access. A nearby plot of land of similar size with similar legal complications sold in September for 11 million US dollar. On 31st December X7, the legal issue were resolved. C company hired a surveyor who stated that it had a fair value of 11.5 million. At that date, C company calculated a fair value gain of 1.5 million as a difference between 10 and 11.5, and this has been recognized in profit and loss account. So there are a number of issues need to discuss. The first thing is the transfer from IS 16 to IS 40. And number two, a fair value measurement. So IFRS 13 would be relevant here. Now, let me give you a short answer first of all, and then we will discuss the answer in detail. The claim of the entity that, first of all, on in 1st September, as the land was still not developed and there was no need of a car park, they decided to lease it. So they want to treat it as an investment property. And on 1st September X7, there is a transfer of this land from IS 16 to IS 40, from property, plant and equipment to investment property. Now, if they using the fair value model, then land before its transfer, it should be measured at fair value. Should be measured at fair value. And obviously the fair value should be measured reliably. And the fair value on the date of the transfer was reliably measurable. Their claim was that it is very complicated. There are complications. The fair value cannot be measured, but a nearby plot in a similar locality has been sold for 11 million. It's an evidence that the fair value of the land is 11 million. It is a market assessment approach. So 11 million is a fair value. So I think it should be measured at 11 million before we transfer it from 16 to 40. And when we will measure it at 11 million, there will be a 1 million gain, and that gain will be recorded in other comprehensive income. It should be recorded in other comprehensive income. On the date of transfer, everything will be done as per the previous standard. So we will transfer it at 11 million, but before we transfer it 11 million, we will re-measure it at fair value of 11 million on the date of transfer, and the gain will be treated as per IAS 16 in a revaluation gain. Yes, subsequently in IAS 41, once it has been transferred, there will be no depreciation on investment property as we are using the fair value model. And at the year end, the fair value has been further increased to 11 by 0.5 million. It become 11.5. Now that increase of 0.5 million should be recorded in profit and loss account. So the management is wrong, the C company is wrong to treat the entire 1.5 million gain in profit and loss account. 1 million gain should be reversed for profit and loss, and it should be recorded in other comprehensive income, and only 0.5 million gain should be recorded in profit and loss account. You got this? Here you have the answer. Kindly read the answer. The cost of the land was correctly recognized as a property, plant and equipment on December 6. However, with the change of use from business purpose to property which will earn rental income, it should be recorded as investment property on 1st September, from 1st September exam. And investment property give the choice to use cost model or fair value model. And if the fair value model is not reliably measurable, then entity should use the cost model. It is only the exceptional case where the fair value cannot be measured reliably. And C company had a good understanding of how to determine the fair value of the land when determining the purchase price it was willing to pay. Moreover, similar plot of the land had recently been sold for 11 million. So as per the IFRS 13 fair value measurement, this would most likely continue a level 2 or level 3 input to make the market-based approach. And when an owner-occupied property become an investment property carried at fair value, C should record any difference at that date between carrying amount of the property and fair value in a revaluation according to IAS 16. So on 1st September, 1 million gain should be recorded in other comprehensive income. Yes, after the transfer, any further increase or decrease in a fair value will be recorded in profit and loss. So as I told you, 1 million should be recorded in other comprehensive income, and 0.5 million should be recorded in profit and loss account. Yes, got it? So this is another question number 3. And you can see that in question 3 mostly they are talking about the accounting issue. We have a case studies related on accounting standard. Here we have IFRS 16, we have IAS 40, IAS 16, IFRS 13, we have IFRS 5. Okay, but the question is not completed yet. There is an other exhibit, and the requirement of that exhibit is using exhibit 4, discuss how payment made to acquire an option should be accounted for in a year ended 31st December X7. Payment made to acquire an option should be accounted for year that ended 31st December X7. Now for that purpose, we have the following exhibit, and I would recommend you that kindly read the exhibit. Kindly read it. So have you read it? Yes, students, have you read this? Okay. Okay, then tell me, uh, which of the standards are relevant to discuss this case study? Can anyone identify? Yes, Matlesh. IS 21 and IFRS 9, both 21 and IFRS 9. Dear student, how there is a touch of IFRS 9. Basically, not, I would not say the IFRS 9, but the scope. The scope of IFRS 9 is tested along with IS 21. You know that we have an instrument which is known as derivative contract, and derivative contract can be on a financial instrument, or it could be a non-financial instrument. Financial instrument mean currency forward, interest rate forward are the derivative contract, which are the financial instrument, and they are come under the scope of IFRS 9. But the derivative contract on a non-financial items like commodities, crude oil, like any other commodity like wheat, rice, coffee beans, these are the non-financial instrument derivatives. Now, if you have a derivative contract and that is a non-financial instrument, now they can be included in the scope of IFRS 9 if the intention is to settle the contract on net basis, on gain and loss basis. If in a non-financial derivative contract, business has the intention to take the physical delivery of the commodity of the non-financial item as per the need of the business, then it is an executory contract. normal purchase agreement or sale agreement. Executory contracts are the contracts which uh, are not equally performed by the seller and the buyer. Like if I am going to buy 10 kg of wheat for my business purposes, then it is an executory contract. And executory contracts are not financial instruments. They are treated as per the normal purchase of commodity. If we are purchasing a non-current asset, it could be IAS 16. If we are purchasing a commodity like wheat, coffee beans, it could be inventory. Okay. And IAS 21 is involved here because the company functional currency is dollar and they have did the transaction in dinar. Now, keeping these points in mind, now if we read me it again, the functional currency of a C company is the dollar. On 1st December X7, C company paid 10,000 dinar to a property developer for an option to purchase a building situated whereas at a fixed price on 1st July X8. The payment to the property developer is non-refundable. C believe it is highly probable that it will purchase the building. It will purchase the building. It will take the physical delivery. C company proposed to treat the contract as a derivative financial asset measured at fair value through profit and loss in its financial statement for the year ended 31st December X7. This option is a derivative, but a derivative can be treated only as a financial instrument if it involves a financial item, or if it involves a non-financial item, we have an intention to settle it on a net basis. If in case of non-financial item, we have an intention to take the delivery, then it is an executory contract and then it should not be a financial instrument. And if it is not a financial instrument, then it can't be a financial asset or a financial liability. So if you apply this principle here, the C company intention is to purchase the building. They are not going, purchase a building is a non-financial item, non-financial asset. And they does not have the intention to settle it on net basis or on net gain or loss basis. They have an intention to purchase the building. They have the intention to take the physical delivery. So it will be treated as an executory contract and it is outside the scope of IFRS 9. So it cannot be treated as a derivative contract under IFRS 9 at fair value through profit and loss account. Further, you have paid the amount in dinar and the functional currency of the company is dollar. So you have to convert it into the dollar on the initial recognition at a spot rate. And for that purpose, we have a guidance in IAS 21. And here we have the answer. Kindly read it. So in first paragraph, we are ruling out that it is a derivative. It's not a derivative because we have intention to take the physical delivery and it's a non-financial item, a property. So it should not be a derivative. Treated as a derivative under IFRS 9. And yes, IAS 21 is relevant because dinar is a foreign currency and we need to present this transaction into our functional currency, which is US dollar. And but remember, it is a non-monetary item because it is not determinable into fixed and unit number of currency and it cannot be used as a cash and cash equivalent. So it's a non-financial item, non-monetary item, and non-monetary items are not subsequently translated. They are translated once on initial recognition at a spot rate, but then subsequently non-monetary items are not translated again and no foreign exchange gain or loss is recorded unless we are carrying the non-financial, non-monetary asset, non-monetary items at fair value model or at revaluation model. And here the fair value and revaluation model is not applicable because it's just a payment of option. Okay, it is an advance payment basically. So it would not be retranslated again. It would not be retranslated again. You got it? Okay. Now we have a question number 4 from the same paper. Now, in this question, the thing which is discussed along with the various accounting standards, there is a specialized area which has been tested here, which is sustainability reporting. Now, sustainability, if let me tell you the background, the sustainability has becoming very important with the every passing every passing day. And let me tell you, you can find the information about the sustainability reporting in chapter number 21 of the ACCA Study Hub. Sustainability means in a summarized way, in a very simple word, that means uh, the action of the business should be uh, should not be, I would say, it should not be that they should work only for their profits and they sacrifice the society and their resources and they cause any, you can say, any damage caused to the environment. Because if they do it for the profitability, they are not having the sustainable practices. So, due to climate changes and environmental problems, uh, the businesses are now focusing on this issue as well, and on sustainability reporting. Uh, some area, jurisdiction it become mandatory that along with the financial statement, the accountant should disclose the or give a report on the sustainability as well. And in that regard, we have two financial reporting standards on sustainability. One is IFRS S1 and second is IFRS S2. S1 is the general standard which give us the general guidance on the disclosure of the sustainability regarding the risk and opportunity which we are facing from the changing environment. And IFRS S2 sustainability standard reporting 2 is more specific to climate change, that how we are physically affecting the environment and how transitionally we are being affected or we are affecting the environment. So this case study would be focusing on the sustainability. Now, first of all, let's read the requirement first. briefly discussed how materiality approach is different in European sustainability reporting standard compared to the International Financial Reporting Sustainability Disclosure Standard. Dear student, the IFRS standard on sustainability reporting focus on materiality only in terms of financial values. That, for example, how the change in the environment and climate is affecting our profit and loss account, how that is affecting our cash flow statement, and how they are affecting our financial position. So the IFRS sustainability disclosure standard, which we are following because we are the followers of IFRS, that is basically in terms of materiality focus only on financial material. Non-financial material issue they does not consider. So materiality in IFRS sustainability disclosure standard is based on financial materiality, which focus on how the sustainability issues affect the financial performance, financial position, and cash flow. But if we talk about the European sustainability reporting standard, they referred to the materiality to as a double materiality. They focus on financial materiality as above, like on effect on profit and loss, financial position, and the cash flow. But they also focus on an impact materiality, which is how the entity impact the environment and society. Like for example, if we carrying out corporate social responsibility in IFRS sustainability reporting, our focus will be on cost. But in European standard of sustainability reporting, we will not be focusing only on the cost, but we also will be focusing on the outcome of our CSR. Okay, means non-financial side will also be evaluated, also be disclosed in the European sustainability reporting standard. So that is the difference between IFRS sustainability disclosure, which is S1 and S2, and the European sustainability reporting standard. And you will find all this information, let me tell you, in chapter number 21, this chapter. And let me tell you that when you read this chapter on, you just focus on these highlighted areas: IFRS S1, IFRS S2, and European Sustainability Reporting Standard. This is my advice to you, that at least you should go through these areas before your exam in chapter number 21. So coming back to the requirement. So that is the difference of the materiality in IFRS sustainability reporting disclosure and European Union sustainability reporting disclosure. Now, the requirement 2. That is using the exhibit 1 only. Discuss why a Camila company sustainability report does not comply with the IFRS standard disclosure requirement. Standard disclosure requirement. Now, for that purpose, we need to go through the exhibit 1. So you have the exhibit 1 in your front. This is the information. So, Camila company has produced a sustainability report. Sustainability report states that it has been produced in accordance with IFRS Sustainability Disclosure Standard. Due to system issue, K company was unable to capture important data during 20X7, such as sustainability. As such, its sustainability report cover 11 months to 30th November. Now, first of all, the first issue which I am feeling here is that the period of the disclosure on a sustainability should be same as your financial year. So if your financial year financial year is consists of 12 months, so the reporting period should also cover the 12 months. So the first thing is that they are not covering the whole financial period. And number two, the second paragraph, in its climate related disclosure. Climate related disclosure is basically IFRS 2. It is a climate specific sustainability disclosure, okay, in which we disclose the issues relating to physical risk and transition risk and due to the climate change which the company is facing. Such risks are disclosed, and the other disclosure regarding the carbon dioxide emissions in a various capacities need to be disclosed and their effect on the environment and the company. So in its climate-related disclosure, IFRS 2, K company has identified several climate-related opportunities. It has also identified climate-related physical risk, but no other type of risk. For the risk and opportunity identified, K company has disclosed the potential impact on its financial position and financial performance over the next 12 months. Now, another issue which I am feeling here or I am identifying here, they are only identified the physical risk. Now, the physical risk mean the risk arising from the chronic, like rising sea level, sustained heat waves, acute flood, wildfire, climate events. These changes are known as physical changes. You are facing flood, you are facing rising level of the sea, um, unprecedented heat, unprecedented the cold weather. These are the physical risks, physical effects on a business due to change in climate. But there is another risk due to the climate change, which is related to climate, is a transition risk. They haven't identified the transition risk, which should be identified when you are disclosing the climate related issues. Transition risk is the risk which is related or which is associated with the global transition to a lower carbon economy. Now, if in globally it is emphasized that we should move towards a lower carbon economy, then obviously it will affect your businesses. Like for example, transition risk is at the moment is on a businesses which are generating energy using the coal power, using the furnace oil. Globally, these source of power are now discouraged. So that is a transition risk which we face due to the transition. The world in business, the world economy has gone through various transitions. In early industrialization, there was no focus on environment. They were just focused on the profit. Uh, you make the product and you sell the product to a customer without taking care of the customer, without taking care of the environment, without taking care of the social responsibilities. But with the passage of time, there are many transitions. There was the concept of social responsibility, corporate social responsibility. Now there is a concept sustainability, child labor avoidance. That was a transition. Now carbon dioxide emission control, and that affect the businesses around globally when the international powers, the international players decided that we will control the carbon dioxide emission. So such risk which you face or your business face due to transition in a overall environment, business environment due to climate change, new policies, new laws, this is known as transition risk. Risk associated with the global transition to a lower carbon, for example, new climate policies, carbon pricing, carbon taxation, technology change, shift in market sentiment. Okay, these risks are known as transition risk. Now, the problem is that they have identified the physical risk, but they doesn't identify the transition risk. That is the another problem which we can say we have an issue in a report produced by the K company. The K company have disclosed scope 1 greenhouses. Scope 1 greenhouses. Now it is very important. Scope 1 greenhouses mean the greenhouses which are directly produced by the company and they are affecting the climate. For example, the carbon dioxide emission from the company vehicles, the vehicle which the company is using, carbon dioxide emission from the boilers, from the machinery, from the furnaces of the company, or the environment damage causing from the company facilities directly, that is known as scope 1. And it is requirement that we should disclose the scope 1 greenhouse gas emissions. So they have disclosed the scope 1, but it has not disclosed the scope 2 or scope 3. Now, dear students, scope 2 and scope 3 are the indirect, you can say, carbon dioxide emission. For example, you are purchasing the electricity for the use in your factory, for the use in your production, and when you purchase the electricity, electricity is produced by someone else, maybe using the coal power, maybe using the furnace oil. So as you are consuming the more electricity, you are damaging more environment. That is indirect effect, and that is known as scope 2. So they haven't disclosed the scope 2. Now, obviously, the K is a company, is a manufacturing company. So they would be using electricity. No company can survive without the electricity, without the energy. So scope 2 disclosure is compulsory for this, the K company. And they also doesn't disclose the scope 3. Now, scope 3 is basically the greenhouse emissions or effect of to the environment, which is not directly or indirectly under the control of the company, like employees travel, transportation of the goods. Transportation of the good has to be transferred from company to customer. Employee has to transfer, has to travel to continue the economy, to contribute in the economy, to continue the factory. The employees need to travel. There will be disposal of waste. There will be leased asset. There will be purchased goods for production. These things which are not under the control of the company, that is known as scope 3. That is known as scope 3. Now, scope 3 should also be disclosed if they are affecting this, but scope 1 and scope 2 level disclosure must be disclosed by the K company. The problem is that they disclose only the scope 1 and they ignore totally the scope 2 and the scope 3 disclosure in their financial statement. These are the some issues which we have here. Now, several years ago, K company introduced a share-based payment scheme for its director. The option would vest on December X7 if the K company cut scope 1 greenhouse emission by 10% per year on average. This target was not met and the scheme did not vest. No mention is made of the share base in a climate related disclosure. That should also be disclosed that we have given the incentive to motivate the directors, to motivate the employee to work towards the sustainable environment. Okay, that is not disclosed. That should be disclosed. Climate-related disclosure trail in K company's target of becoming net zero within the next decade. Around half of its anticipated carbon reduction is estimated to arise from carbon credits. There is no reference to the use of the carbon credit in disclosure. Carbon credit in disclosure that should also be disclosed. The carbon dioxide emission reduction due to carbon credit certificate. Now, look at here the issue which we have here. The first issue we have identified about the time of reporting. The disclosure should be covering 12 months period, but they are covering only 11 months period. Risk, according to IFRS, sustainability reporting to climate related disclosure, the climate related risk, both the physical risk and the transition risk should be disclosed, should be identified. And these are likely to be significant for K company transition because it manufactures petrol car engine and market for these is likely to diminishes as the demand for the low carbon alternatives. Now, transition risk is very serious for the traditional car manufacturers, and the K is the manufacturer of the engine for the traditional car. Now, we are moving towards the EV car on the assumption that EV cars are less causing less damage to the environment as compared to the traditional cars. Now, this transition is a very serious risk for the automobile industries or the related industries. So, transition risk is very significant for the K company, and they haven't disclosed the detail of the transition risk. They have just disclosed the physical risk, not the transition risk. So for the risk and opportunity identified, K company has disclosed information about the impact on future financial performance and position. K company should also disclose information about the impact on cash flow. Moreover, K company has only disclosed information about the impact over the next 12 months. IFRS S2 states that company should disclose the impact over a short, medium, and long term. It is also a requirement. They are not just focusing the impact on the next 12 months. They want to disclose the impact on 12 months, medium, and long term. Then greenhouse emission, scope related issue. They have disclosed only the scope 1 related disclosure of the gas emission. But IFRS has to state that entity should also disclose information about scope 2 and scope 3 greenhouse emissions. Note that K company would be exempt from the disclosing scope 3 greenhouse emission in its first annual report produced under IFRS sustainability disclosure standard. The company who are giving disclosure first time, they are exempted just for once, but after that they will be required to disclose the scope 3 as well. Although it can be difficult to measure the greenhouse gas emission, particularly scope 3, as to prescribe the use of the greenhouse gas protocols. A corporate accounting and reporting standard when doing so, unless entity jurisdiction or exchange require use of different methods to increase the comparability between entities. Measurement uncertainty will arise, but K company should disclose information about its measurement approach as well as the input and the assumption they have used to measure the scope 2 and scope 3 carbon dioxide emissions. Then there was issue that they given a target to reduce the greenhouse emissions, and the director failed to meet that. Director employees failed to meet that target. So that fact need to be disclosed. So IFRS S2, company should disclose climate-related target which it has set to monitor its progress. The share-based payment was based on a clear target to reduce the greenhouse gas emission by an average 10% per year. As such, K company should have disclosed the metric used, the objective of the target. Metric means the benchmark they have to measure the reduction. What is the objective of the target? The period over which that target should be fulfilled, and the fact that this climate target has not been fulfilled, that information should be disclosed. And if it is not disclosed, it is also another problem in the sustainability reporting produced by the K company. Then there is a carbon credits. Carbon credits, basically you can say the incentives to contribute positively towards the environment. So the K company uses carbon credit. According to IFRS 2, K company should have disclosed the fact that 50% of its carbon reduction target is based on the use of carbon credits. It all should also have disclosed the type of carbon credit used. For example, whether they are based on carbon reduction or removal, and other factor to help the user assess the credibility and integrity of the carbon credit. That fact also need to be disclosed, that they have a carbon credits and they have used a carbon credit to report 50% reduction in the carbon production or the carbon incorporation in the environment. So these were the some issues we have in a sustainability reporting of the K company. Now and it was having total 10 marks. Now the next requirement, that is using exhibit 2, discuss the impact of climate change on a following issues in a K company financial statement: financial asset and the recognition of the deferred tax. Financial asset and the recognition of deferred tax asset. But okay, before I read the exhibit 2, what could be the effect on financial asset and deferred tax asset? Look, due to climate change in a various part of the world, there are floods, there are tsunamis, extreme weather changes, and what or which things or which part of the society is mostly affected by these climates? Obviously the human. And who are the human? Human are the customer of the company. Human are the borrower of the company. Humans are the lender of the company. They are the investor. They are the borrowers. Okay. So now let's assume, basically they are talking about in exhibit, they have talked about in a requirement, they have talked about the financial asset. Now let's say the company has some investment in a company, and that company is operating in a part of the world which is under the severe climate changes. So if that part of the world is under the severe climate changes and your company in which you have invested is operating in that region, obviously the ability of that company to pay back you would be reduced. So it can trigger the recognition of impairment loss or a loss allowance on a financial asset. Similarly, due to climate change, you might have to suffer losses, trading losses, and on the trading losses, if you carry forward them, you may have to recognize the deferred tax asset only to the extent that future taxable profits are available, and the future taxable profit availability significantly would be depending upon the stable climate. So if you have, like in a region where we are situated, from where we are taking class, it is under the severe climate changes, the subcontinent in India, Pakistan, Bangladesh, Sri Lanka, they are under the severe climate changes for last 3-4 years. So if a business is operating in that area which is under the heavy flood during the monsoon, and they have suffered heavy trading losses, now they have trading losses, they have option to carry forward, and they decided to carry forward. Now, in order to record the debt tax asset on that trading losses, there must be a future taxable profit, but flood will again come in that area in a coming monsoon again in 2026. There will be again severe climate uh, changes which will severely hit again the people, again the business. So how you are confirmed, or you can say that in future you will be having the future taxable profit? So obviously it will, climate change will also affect the recognition of the debt tax asset. So now you can, if, with this discussion, now you can conclude that why the accountants are now very concerned about the climate change. It is not the climate change. It is not the change in environment. It is basically affecting the businesses. And when it affecting the businesses, it will create risk and it will create opportunities which need to be quantified. That's why now there is emphasized that there should be a sustainability reporting disclosure in a financial statement. So now, keeping in mind in the requirement that what would be the effect on financial asset and deferred tax, now we will look at the exhibit. So first of all, the financial asset. The K company is currently assessing the impact of climate change on a financial statement. K company has extended loans to its key supplier to help ensure their viability. K company has recognized these loans as financial assets. K company hold loan of this type with an intention to collect the contractual cash flow. So it's a financial asset, and it will be classified as amortized cost under IFRS 9. The K company and supplier have been affected by wildfire and flooding. In addition, there have been considerable policy and regulatory change which have affected all parties. Significant uncertainty exists around the impact of the climate change scenario on K company and its supplier's business model. Now you have the K company has given loans, they have invested in their suppliers, they have recorded that as a financial asset at amortized cost under IFRS 9. And now due to climate change, due to climate change, flood, wildfires, they have been affected. So ability of their supplier to pay back them has been affected. So there is a chance now that due to these climate changes, your borrower, the company in which you have invested, your supplier, may default. They would not be able to pay you back full. So it has created uncertainty on the part of the supplier. So it will trigger the recognition of lifetime credit losses, or even it would trigger to recognize the impairment losses on the financial assets. So this is how the climate change is going to affect the accounting of the financial asset of the K company. You got this? So you can read here, the financial assets are measured at amortized cost and therefore fall within the impairment requirement of IFRS 9. It's a amortized cost method financial assets, so they are subject to impairment of IFRS 9. But if they are paid through profit loss account, or if they are equity investment, then they would not be uh, subject to impairment, because the impairment model of IFRS 9 is only applicable on investment in debt, which are classified at amortized cost or fair value through other comprehensive income. And other than that, it is applicable on lease receivable and contract assets. So their financial asset is at amortized cost, so they are subject to impairment requirement of IFRS 9. Climate-related matter may affect the K company exposure to credit losses. Wildfire, flood, and policy and regulatory change could negatively affect the borrower's ability to meet its debt obligation to K. Further, asset could be affected by climate change, which would result in a reduction of the worth of the security for the loan. Another aspect, they are affecting the ability of your supplier to pay back, and even if you have a security against the loan, the value of that security would also affect it due to the climate change, due to the flood, due to the wildfire. Obviously, the value of the asset would fall, the value of the security will fall. So it recognizing and measuring expected credit losses. 12-month expected credit loss we normally record. It may trigger to calculate or to record the lifetime expected credit loss allowance, or maybe it may require to record the impairment on financial assets. Okay. So you may have to replace your 12-month expected credit loss model with lifetime expected credit loss model. Yes, students, any question? The next part of the same requirement is to effect of the climate change on the recognition of deferred tax asset on deferred tax asset. Okay. Read the deferred tax asset. K company has been loss making for last 2 years. They are already making losses. These losses can be carried forward to reduce the taxable profit in a future year. K company has recognized material deferred tax asset in respect of these losses. They have recognized the tax asset because they are expecting that in future there will be taxable profit, there will be tax liabilities against which these assets can be used to reduce the tax payments. Many of the K company suppliers are incurring costs in order to reduce the carbon emission during their production processes. This will cause a purchase price of raw material used by K company to increase. So future taxable profitability would decrease because cost of doing business will increase. Due to an increase in the popularity of the electric cars, K company has forecast decrease in demand for many of its product lines. Now, due to climate change, the supplier has been affected, so the raw material prices has been increased. So your cost of doing business has been increased. So future profit, expectation of future profit has been reduced. Number one. Number two, another sustainability issue, climate issue is that now the buyer of or the user of the car now moving towards the use of the EV cars instead of using the traditional petrol-based or diesel-based engines car. So it would affect the demand of the K product as well because the K company produce the engine for cars. So when the EV car will be used, the demand of their engine would reduce. So it would affect the business adversely. Now, if the business will be affected adversely, there will be less future taxable profit. So the deferred tax asset which they have already recognized may need to be de-recognized. That might need to be reduced because the expectation that in future there will be the taxable profit has been reduced now, has been reduced now. And here you have the answer. Kindly read it. Deferred tax asset for deductible temporary difference and unused tax losses and credit recognized under IAS 12 income tax to the extent that it is probable that future taxable profit will be available against which those amounts can be utilized. Suppliers are likely to increase their price and this will lead to lower profit in future periods. Some of the KA company products are likely to become less popular and once again it will have a negative effect on the future profit. The impact of the climate change is creating uncertainty. This is likely to mean that KA company cannot forecast the future profit with much certainty. As a result of the above, future profits may be less likely and K company may be unable to recognize a deferred tax asset or could be required to de-recognize its deferred tax assets, which were previously recognized. Got it? Climate change has been linked with the financial consequence. Got it? And now the next requirement we have here, using Exhibit 3 in accordance with IFRS 2 share-based payment, we have to explain how the share-based payment should be accounted for in a K company financial statement for the year ended 31st December X7. So share-based payment discussion and their accounting we need to discuss. But now, dear student, we will take a short break. Now we'll take a short break, and after the break, I will continue a discussion on this question, okay? And this short break will last 20 minutes. Kindly take a break. Okay, welcome back. So now we have the third requirement, and that is using Exhibit 3 and in accordance with IFRS 2 share-based payment, explain how the share-based payment should be accounted for the K company financial statement for the year ended 31st December at 7. So now we have the exhibit number 3. So on 1st January at 4, K company introduced a share-based payment scheme for its 10 directors. Each director was granted 15,000 share option. The fair value of an option at this date was $8. The option would vest on 31st December at 7 if K company cut its scope 1 greenhouse gas emission by average 10% per year over the 4-year period. So first of all, dear students, it is IFRS 2 share-based payment, and in share-based payment, it's equity settled share-based payment, and it's with employees. And it is measured at the fair value of the instrument at grant date, and it will recognize or it will vest over the vesting period. Vesting period is a time period over which the vesting conditions should be satisfied. Now there are various vesting conditions, service condition, the time period you have to complete, then non-market performance condition and market-based condition. Now here the 10% reduction in greenhouse gases is a non-market performance condition. And the service condition and non-market condition must be fulfilled. If they are not fulfilled, we will adjust our estimate. Yes, as far as the market-based conditions are concerned, they are measurement adjustments at the date of measurement. So subsequently, if they are not fulfilled, that does not affect the recognition of the expense. So here, the 10% reduction in a greenhouse gases is a non-market performance condition which should be fulfilled over the next 4 years on average. Now at 31st December at 6, none of the director had left the company or were expected to leave in the next 12 months. A company was on a track to meet the greenhouse gas target, meaning the share option were expected to vest and the share-based payment scheme was correctly accounted for in a financial statement 31st December at 6. So there were 15,000 directors. Each director, there are 10 directors and each director will get 15,000 share option. And at the grant date, the pay value is $8. So X4, X5, X6. So 3 years has been completed. So 3 by 4 out of 4, 3 years has been completed successfully. And in these 3 years, target seems to be fulfilled. So the total expense which has been recognized till here will be $90,000. And into 10, yes, $9 lakh. This has been recognized till December X6 by debiting expense and crediting equity till December X6. But however, in December exam, due to some unanticipated changes in a production processes, the greenhouse gas target was not met. Condition was not fulfilled. And this 10% reduction condition is a non-market performance condition which should be fulfilled. Now, if it is not fulfilled, then that means the directors are not entitled. So you have to reverse it. You have to reverse the total expense. And in that case, in next 7, equity will be debited, will be derecognized, and expense will be credited with 9 lakh US thousand dollars. Okay, because the non-market performance condition is not fulfilled. So if it is not fulfilled, then the entire value will be reversed. Got it? So in accordance with IFRS 2 share-based payment, an expense should be recognized in respect of the share-based payment scheme over the 4-year vesting period on the number of options expected to vest. As an equity settled scheme, the expense is measured using the fair value of the option at the grant date, which is $8 per option. The greenhouse gas target is a non-market performance condition. As at December 6, it was expected to be met. The total expense and equity recognized is 9 lakh US thousand dollars, 9 lakh US dollars, 10 into 15 into 8 into 3 by 4. But in the year ended December exam in the current year, option is not vested, the target is not fulfilled, non-market performance condition is not fulfilled. So the expense, cumulative expense which we have recognized and cumulative equity we have recognized at December 6 would be reversed. So the expense we have recorded need to be reversed. So that would be the accounting of this transaction as per share-based payment. So that was the question number 4. Another question. From the past paper, I think it is from 2020. So the Liverpool is an internationally successful football club. Lyria company is preparing financial statement for the year ending 31st October X5, but is currently facing liquidity problems. Now, the first exhibit is about stadium sale and lease back and improvement. So the Lyria Co has entered into a contract regarding its stadium, whereby it will sell the stadium on 30th November X6 and immediately lease it back. The directors of the Lyria Co wish to classify the stadium as a non-current asset held for sale in its financial statement for the year ended 31st October X5, as they believe the sale to be highly probable to date that. So the year end is 31st October X5, and they expect to complete the sale of the stadium by 30th November X6. And they want to treat this, and they will sell it and lease it back, and they want to treat the stadium as a held for sale asset at the year end. The sale contract required the disposal of the stadium for its fair value of 30 million US dollar, and for Lyria company to lease it back over the 10 years. The present value of the lease payment at a market rate on 30th November X6 will be 26. The market value of the stadium of this type has not changed in several years and is unlikely to change in the near future. The stadium is being depreciated 5% per annum using the reducing balance method. In the year 31st October X6, it is anticipated that $2 million will be spent to improve the crowd barriers in a stadium, and there is no legal requirement to improve the crowd barriers. Lyria company has incorrectly treated this amount as a reduction of assets carrying amount at 31st October X5, and corresponding debit has been made in profit and loss. At 31st October X5, the carrying amount of the stadium after depreciation and the deduction of the carry forward crowd barrier improvement is 18 million. This is the first exhibit, and now look at the requirement. Discuss with reference to the International Financial Reporting Standard whether the director can classify the stadium as held for sale. Can director classify the stadium as held for sale? Dear student, answer is no. It's not held for sale non-current asset. Stadium cannot be classified as held for sale asset. Now, what are the reasons? Now, dear student, held for sale asset is an asset which is available for immediate sale, and sale is highly probable. And in order to be highly probable sale, the sale should be completed within 12 months. And today is 31st October X5, and sale is expected to take place on 30th November X6. These are 13 months beyond the 12 months period. So the sale is not highly probable. So on that basis, it can't be held for sale. So we cannot treat the asset as held for sale asset. Further, this is a transaction of sale and lease back. And sale and lease back is an issue of IFRS 16 leases, not IFRS 5. So it's not held for sale. It cannot be classified as held for sale. Okay. And here you have the answer. Kindly read this answer. Read the answer and try to understand how they have write the answer, how they have given the logics. Kindly read it. So have you read it? Now the second requirement of this exhibit. Linear company accounting treatment of the crowd barriers improvement at 31st October X5. So in the last paragraph, they talked about the it was anticipated that there will be an improvement expenditure in crowd barriers in a year to 31st October X6, and this they treat this as a and they treat this and they treat this as a reduction in the carrying value of the stadium, and after the reducing that value they have a carrying value of 18 million. Now dear student, it was an future operating cost which may be incurred in the coming year, but it's not an compulsory cost. It's not an obligation on a company to incur this expenditure. But what they have treated it as an impairment, and they have recognized the future repair expense as an impairment on the carrying value of the asset, and it is totally wrong. It should not be treated as an impairment. It is a future operating cost. When it will be incurred, it will be recorded in profit and loss. Before that, it cannot be recognized in advance, and especially not as an impairment. So we need to reverse it, and the carrying value of the stadium will be restated to 20 million US dollar. To 20 million US dollar. 18 plus 2. Okay. And here you have the answer. So it should not be treated as an impairment in the carrying amount at December exit, as there is no obligation, legal or constructive, as a result of the past month. Okay, so the way they have treated this future anticipated cost as a reduction in the carrying value of the stadium is totally wrong. That need to be reversed. Now the third requirement, the principal accounting treatment of the sale and lease back of the stadium at 30th November X6. Now, dear students, sales and leaseback is an issue of IFRS 16. And IFRS 16 says before we apply the sales and leaseback, we need to confirm whether the transfer of the asset satisfies the sale criteria of IFRS 15. If it is not satisfied the IFRS 15 criteria, then it's not sales and leaseback. Then the amount we have received or we will receive as a sale proceed will be treated as a financial liability under IFRS 9 if the revenue criteria is not fulfilled. But if the sale criteria is fulfilled, then it's sales and leaseback. And if it is a sales and leaseback, then the property, plant and equipment will be de-recognized, a lease liability will be recognized, a right of use asset will be recognized, the bank will be recognized at a sale proceed, and there will be a gain or maybe there will be a loss on disposal which need to be recognized if the sale criteria is fulfilled. Now let's say if the sale criteria is fulfilled, then on 30th November X6, you will de-recognize the carrying value of the stadium. And the carrying value of the stadium at 30th November X6 will be 20. And the stadium is depreciated at 5% using the reducing balance method. So 1 million depreciation and it will be carrying value of 19. And this carrying value is at 31st October X6, but there will be 1 month depreciation further because it will be sold and leased back at 30th November. So 19 minus 0.08 on the time of the transaction, carrying value of the stadium would be 18.92. The bank will be debited with 30 million and a lease liability will be recognized at the present value of the lease payment, which is given in a question, 26 million US dollars. And a right of use asset will be recognized and a proportionate value of the right of use asset will be recognized, which will be equal to carrying value divided by fair value multiplied by lease liability. Carrying value is 18.92 divided by fair value into lease liability 26. So 18.92 divided by 30 into 26. So 16.4. Right of use asset will be recognized at 16.4, a proportionate value. And the balancing figure will be equals to 1.48 and it will be on credit side, and that would be the proportionate gain on disposal 1.48, and that gain on disposal will be recognized in profit and loss account. So this is the principal accounting treatment of sales and leaseback. If the sale criteria is not fulfilled, then the amount received of 30 million will be recorded as a financial liability. But if the revenue criteria is fulfilled, you will de-recognize the asset, recognize the sale proceed at a fair value, a gain or loss will be recognized, right of use asset will be recognized, and the lease liability will be recognized. And the calculation will be as follow, and you can see the entry. You have 1.48 gain on disposal. Now in a part B, the question is requirement is whether the amortization of the intangible asset related to television program content rights by media company and by industry are acceptable policies in accordance with IFRS standard. Now, this is the exhibit. Kindly read it. Kindly read this exhibit. So have you read it? So the story is that Lydia has a subscription-based television station, and they have material intangible assets relating to content right associated with the television program, and their amortization method which they are using is some sort of based on the watching time, consumption base, okay, and their competitor are using the useful life straight line based method for the depreciation. So the budgeted costs of the production are based on estimated future revenue for television program. These costs of production are then capitalized as intangible asset called content right, and the director believes that the intellectual property in a content right is consumed as customer view the television program. So they have decided that they will amortize the content right based on the estimated future revenue from the television program. So revenue-based amortization method. Like, for example, if television program is expected to generate 8 million revenue in total and 4 million revenue in generating year one, so 50% of the cost will be depreciated in a year one. But in industry practices, it is depreciated by the competitor over remaining useful life. Now, dear student, first of all, both methods are allowable if they are appropriate with the consumption pattern. But IS 38 discourage, or you can say recommend, that the amortization should not be based on revenues. It should not be based on revenue generation basis. It is a recommendation, but it is not. It doesn't mean that it is compulsory. It can be, if as far as it is appropriate, if it is giving you a systematic allocation, you can use it. And similarly, the industry, the competitor are using calculating the amortization on the basis of remaining life. That is also appropriate. So the both methods are appropriate. So yes, it can be used, but not recommended. But keep in mind, it's not recommended by IS 38. So now look at how they have discussed it. They will discuss the amortization, then definition, then they will talk about the useful life in intangible asset. There is definite life, and then there is indefinite life. Definite life intangible assets are amortized over the remaining life, and the indefinite life are not amortized, they are tested for impairment. And then they are discussing the appropriateness of the both methods, the revenue-based method and the remaining useful life-based method, and both methods are appropriate. But in the case study, you will read that revenue-based amortization method is not generally recommendable by the IS 38, but yes, but it can be used as far as it gives you the appropriate assessment of the consumption. If it giving you the appropriate assessment of the consumption, it can be. So linear company accounting policy based amortization of the intangible asset for the content right on revenue streaming from the right seems reasonable and systematic. However, IS 38 intangible asset set out rebutable presumption that amortization based on revenue generated by an activity which include the use of intangible asset is not appropriate. This presumption can be overcome when it can be demonstrated that revenue and the consumption of the benefit of the intangible asset are highly correlated. The intellectual property embodied in a television program will generate cash flow through the television channel subscription, and estimated revenues for the television program determine the amount to be spent producing the television program. Therefore, revenue reflects a proxy for the pattern of consumption of the benefit received. Revenues and consumption of the economic benefit of the intangible asset seem highly correlated, and therefore revenue based on amortization method seem appropriate. The industry practice method is also acceptable and conceptually sound as it is based on analysis of the remaining useful life of the program and recoverable amount. Such approach does not contradict IS 38 amortization. The useful life on intangible asset required to be assessed in accordance with IFRS standard at least at the each year end, where this result in change in estimate, this will be accounted for prospectively from the date of reassessment. Okay, so both are appropriate. Then we have the last requirement, how to account for the player contract cost, including contingent performance condition, any impairment which might be required to these non-current assets, and whether the player can be considered as a single cash generating unit or not. So player registration contract costs are shown as an intangible asset and are initially recognized at fair value of the consideration paid for their acquisition. However, the subsequently player contract are often renegotiated at a cost. Also, the player contract may contain contingent performance condition where individual player may be paid bonus based on their success in terms of the goals scored or the success of the football team as a whole. These bonuses represent additional contract costs. For impairment purpose, area company does not consider that it is possible to determine the value use of an individual player unless the player were to suffer career-threatening injury and cannot be playing in the team. Players only generate direct cash flow when they are sold to another football club. So, how the player registration cost will be measured? It is intangible asset. Initially, it will be measured at cost. Cost will include all the directly attributable expenditure, and the consideration which is incurred will be part of the initial cost. Okay, initial measurement. There is an contingent payment as well that would be based on the performance. That contingent payment will also become part of the initial cost on the basis of the probability. You have to assess that what is the probability that the bonus have to be paid, and on that basis, the bonus amount should also become part of the contract cost initially recognized. Now, the second issue, impairment purposes, can we consider the single player as a cash generating unit? Now, as far as the team is concerned, in a playing 11, no individual player can be considered as a single cash generating unit. It is basically the whole team which will be considered as a cash generating unit. So if there is any indication of impairment, the whole team, the whole club will be tested for impairment. Individual player cannot be tested for impairment because it is not a cash generating unit on the basis of we cannot say it's a cash generating unit on the basis of individual player. Yes, when it will be sold to another club, on that time it could be considered a single player as a cash generating unit. But while the player is playing, it will be the team which will be considered as a CGU. It will be a club which will be considered as a CGU, not the single player. Not the single player. So when a player contract is signed, management should make assessment of the likely outcome of the program performance condition. Contingent consideration will be recognized in a player initial registration cost if the management believes the performance condition will be met in line with the contractual term. Periodic reassessment of the contingent consideration should be made. Any contingent amount which the director of the media company believes will be payable should be included in a player contract cost from the date management believe that the performance condition will be met. Any additional amount of the contingent consideration not included in the cost of player registration will be disclosed separately as a commitment. Amortization of the cost of the contract will be based upon the length of the player contract. The cost associated with the negotiation of the playing contract should be added to the residual balance of the player contract cost at the date of signing the contract extension. The revised carrying amount should be amortized over the remaining renegotiated contract period. Where the player sustains a career-threatening injury and is removed from the playing team, the carrying amount of the individual player would be assessed against the best estimate of the individual fair value less any cost to sell, and impairment charge made in a operating expense reflecting any loss arising if there is a career-threatening injury. But it is unlikely that an individual player can be separate single cash generating unit, as this is likely to be the playing squad. Also, it is difficult to determine the value and use of the individual player in isolation, as player cannot generate cash flow on their own unless via sale. Okay, so that was the application of IS 38 on the player contract cost. Okay, now student, you have the exam kit with you guys. Uh, I would recommend you that you people should go through the exam kit. It will help you a lot to create the writing skills in the exam while answering the question. So do each and every question from this exam kit. And for question number one, especially the pre-populated spreadsheet question, use the ACCA practice platform for practice purposes. And for sustainability reporting, I told you that you people should at least go through these areas 21.2.7 and 21.2.8 from sustainability reporting. You will find it in chapter 21. Okay. Other than that, some another very important area which you people should go through before you go for the exam. So in chapter number 20, you will go from, you will read the IFRS 8 operating segment, that is still important. But in this chapter, this is an important area, APM, additional performance measurement. Kindly note, other than standard, you will cover all your accounting standards, you will do the consolidation, and after that, you will go through the as IFRS S1 and IFRS S2 from chapter number 21. And then from chapter number 20, you will go through the additional performance measures. These are very important. From these areas, 5 to 10% of your exam can be tested. 5 to 10% of your exam can be tested. So kindly note these areas other than the accounting standards. Then from chapter number 4, kindly go through the presentation and disclosure of the financial instrument IFRS 18. Especially look at the new format of the profit and loss account and the aggregation and disaggregation criteria. It's very important. Aggregation and disaggregation criteria. Aggregation means same nature of expenses will be aggregated and presented in a single, in a one line, like all operating and admin expenditure will be reported as operating and admin, but impairment of goodwill should be presented separately. It should not be aggregated because it has its own significance. So if you club it with the other expenditure, it would undermine the significance of the expenditure, and this is called aggregation and disaggregation criteria. So it is very important in IFRS 18 for your exam, other than your accounting standard. other than your accounting standard. So these are some guidelines which you people should follow. And I have shared some material in the WhatsApp group as well. There are some video lectures recorded. I have shared with you. I have shared two technical articles. Kindly go through those articles as well before you go for the exam. Go through the technical articles as well. Okay, and my last guideline for you guys is that read all the accounting standards. It's very important for in SBR. Study the accounting standards from ACCA Study Hub or the latest Kaplan exam book or from the notes. But read the accounting standards and develop the conceptual understanding of the accounting standard. It is very, very important for SBR exam. Because in these practice sessions, one thing you have noticed that in every requirement, other than the group account where you will be given a pre-populated spreadsheet, every requirement involves the discussion, explanation. So for that purpose, you should have a very good grip on the accounting standard, and that grip can only be achieved if you study the accounting standard. And I would recommend you, if you have a time, read the accounting standard and create a short summary. Read the accounting standard from the study hub and create a short summary, especially regarding the recognition criteria and the measurement criteria. So it will help you in a revision and it will help you a lot in passing your SBR exam. Okay, that is my guideline. And today is, I think, is 20th November, and you still have, I think, 12, 13, 14 days. You still have. Do everything. Just cover all the syllabus, cover all the standard, and in the meanwhile, if you people have any problem regarding your preparation of exam, you have any question, you have any query, you all have my WhatsApp number. You are all the member of the WhatsApp group. You can contact me through the group or on individual basis. Okay, I will take your queries and I will respond your queries. Okay, so best of luck, dear student. Best of luck, and may you succeed in your exam with very good marks. Okay, so thank you very much and goodbye and take care. And kindly after when you take your exam, kindly give me your feedback that how was the exam, and kindly share your result as well. Thank you very much.